Hey guys, what's going on? In this video, we are going to talk about my favorite price ranges to trade in and why I like to stay in these areas. I am also going to talk about contract links. So if you don't know who I am, my name is James Mason. I am one of the founders for Transparent Traders. You can check us out on Facebook. And we offer a free 40 video course on how to trade. So let's get into it. So what ranges do I like to trade in? Well, I like to trade in ranges with stocks that are between $100 and $400. Now, if I was, trading with shares, that's a lot of money. And it would take a lot of money for it to really be profitable. But since I'm trading options, and the video you're watching right now is actually lesson number 4 in the options trading course. So if you're just now coming into the middle of this, kind of skip back a couple. If you don't know where to go, just check out my playlist section. So for options are obviously a lot cheaper than buying shares. Now, the downside is with shares, you can keep them forever. With options, they expire. They're contracts. So they have a time limit. So, I briefly just talked about, the price ranges, and I'm going to get into that more in depth here in a second. But let's talk about the contract length. So like I just said, they expire. When you trade options, I highly recommend to buy time. Buying time on your contracts, meaning buying a contract that, say has like a month left. That's kind of like buying insurance. And if you don't make the best, entry, or if the trade kind of goes against you, as long as it doesn't, go drastically in one way or the other, opposite of your trade, you have time for this to work out. So this is why I say to buy enough time on your contracts. If you're buying, say, contracts that only just have a few days left, if it's about ready to expire, and all contracts expire on Fridays. So Fridays at the end of the day, contracts expire. So you have what they call weeklies, and it's just different levels, for different weeks that you can buy these contracts. But your standard monthlies, they actually expire every third Friday of every month. So make sure you buy enough time to hold you over in your trade. It would behoove you to do this. Trust me on this one. So let's look at the price ranges and why I say this. So here I have Apple. Everybody knows who Apple is. It's one of the it's one of the best day trading stocks that there is. I mean, there's a ton of volume behind Apple. I'd say it's actually probably second to to the S&P 500. So SPY. So Apple has a ton of daily volume, and you can see right here. Look up here. You'll see it in a second. So this is for today, February the 13th, and you can see right up there it had 22.5 million shares traded. So when you're looking for these trades, make sure you have enough volume in these tickers, because that will help out with the spread, and it just makes life easier. So with these price ranges, $100 to $400 that I like to stay in, the reason is, we'll go right here to trade. This is where you buy and sell options. Well, if you look right here, if I'm buying right at the money, so for this strike price and this is going to be kind of off because this is after hours, and and obviously the prices have fluctuated in the aftermarket. So this will be a little bit off, and if you look at this during the live market, obviously, things will look different, but still, same concept. So here we are. So if you look at the strike price right here, this is a strike price of 167.5, so $167.50. Clearly we are past that right here, but it is what it is for this video because this is, again, aftermarket. So when it closed out at this point right here for the strike price, I could have bought this. I could have bought one contract for $320. So if you see this, this is, it looks like it says $3.20. Well, being that every contract controls 100 shares, it would be 100 times, 320. So it would be $320 plus, your commission fees. So if I was going to buy one contract of Apple at this strike price before the market closed, I'd have paid $320 and my trading fees. Now, being that this is a call, if I took this position, I am wanting to see this increase. So if this increased and, went past my strike price or however you took, that trade, if this increased in price, especially, by this much right here, you're you're going to make pretty good money. Now, back to why I trade between the $100 and $400 range, and honestly preferably, tongue-tied, see I can't even talk. My preferred range, like my sweet spot, is definitely between 100 and 250. So that is like my perfect range, but I'll go up to $400 if there's enough volume. That's the key, because once you start getting that expensive, volume kind of starts dying off. So especially between 100 and 250, that usually tends to be my sweet spot. Now, with that said, let's see. So let's go look at the chart. And just remember, one contract would have been $320. Well, if you look at these daily ranges, so look up here, you'll look at the lows and the highs. So for today, the low, $169.92. The high, $172.48. And you can go back and look at this. And the reason why I say this range is because this range, they tend to move, in those increments of dollars like that. There's more of a chance for these larger cap stocks to move like that compared to a cheap stock that has options to trade. So if we go over here, look at ticker AXSM. Okay, this would have been nice if you'd got in right here with these options and it spiked. I mean, you'd make killer money, but hindsight's always 20/20. So let's look right here. The low, $8.95. The high, $9.46. You see where I'm going with this? So a cheaper stock, they tend not to move that much compared to these larger cap stocks. And that's what you need in these option trades to make money. You need this obviously to move in your direction, but you need these to move as much as possible. So basically, there's more meat on these larger caps than these smaller ones. So let's look right here. This doesn't have as many contracts like Apple would. These only have the monthlies. So yeah, you can look right here, and this is $2, so $200 if you bought it at that strike price. Well, the thing is, this is the $7.50 strike price. We're already up to $9.14. So for you to, if you bought this right now, for you to make any money, this thing needs to start pushing towards $10. I mean, that's on the way to it. So what's really the odds for this thing to push, closer to $10 at this point? This is cheap because there's only 2 days left. You don't have enough time for this to work out, for it to push really that much. That's, for this range, that's a lot of range for this to move. Now, yeah, you could buy these ones right here for 15 cents, but again, you have 2 days. Like, you really need this thing to push pretty close. You could make a little bit money, whatever, but still, it's just really not realistic for these lower caps to move that much unless if they have like just a killer catalyst pushing it. Same for right here. This is the March 15th, so this is the next month. You have 30 days left, and that's a nice time frame to have left on your contracts. So look right here, $250 per contract. So back to what I was saying about buy time. Sometimes it doesn't really cost that much more to buy time. So if you look right here, you can pay $200 for one contract. You only have 2 days left. Or you can have a month left and pay $250. So this one right here, there's more of a chance for it to hit $10 in the next 30 days than this one. So I hope that makes sense right there. I hope you could see that. I mean, that's simple math, that's simple, probabilities. Like, just pay the extra $50, for this scenario right here. Pay the extra $50 to have the extra 30 days, even if you just keep this for today. Trust me, the peace of mind will make up for it. So, let's see. Let's go back to Apple real quick. We'll go look at that March 15th one for Apple. Now, it will be a lot more expensive because, these move in these big ranges because they're large caps. So let's just say we bought this one today, right here at the money. We still have 30 days left on this contract. This contract will cost $785 for this contract. That is a lot of money. But if this thing in the next 30 days, let's just say it was a good trade within the next 30 days, hopefully sooner. If it drastically moved, let's just say this $5 range now, look at the difference. This moved in dollars. So, this thing, you would have had, you also got to think too, though. If you would have bought it, right now, we're already sitting, let's see where it closed at today. Hold on. Okay, so this tanked at the end of the day. So obviously this one started downtrending, but still, just for the scenario, we're just talking in context of this going up. So this I was thinking that this one probably had like gapped up or something. I didn't even watch it today. But going back to this, let's just say, we had bought in at the best chance we could have. And so basically, let's just say if this was like near like 165, and this is just going to be for simple math. So basically, we bought in near 165, and let's just say we paid that much for it. And it moved $5, and now this is what it's worth. So almost right there, that's almost a $4 gain. So, with that almost $4 gain, just do the math, It controls 100 shares per contract, so that profit would be almost $400. So you see where I'm going? With these larger caps, they move within dollars. The smaller caps, you have to buy a lot of them. And buying a lot, increases your risk, your leverage, and so on. So I hope this video can help you guys out, help you see the benefit and why I trade in this range. And I hope it helps you guys and to where you can make some money and capitalize on this. So hey, thank you for taking your time to watch this video, and I will see you in the next one.